What if I told you that you could buy 3,100 extra companies for your portfolio, completely diversify across the entire U.S. economy, and then after 10 years of compounding, it would barely change your returns by 0.5%.
I mean, it sounds like a complete math error when you say it out loud like that. You just naturally assume that buying thousands of extra businesses would, drastically alter your financial trajectory.
Right, but it actually doesn't. And that paradox is exactly what we're tearing into today. So welcome to this deep dive into the ultimate indexing showdown.
Because if you spend, well, any time at all looking at your retirement accounts or listening to financial advice, you're just constantly bombarded with this massive debate.
Yeah, exactly. It's the classic question. Should you own the entire stock market to be as safe and diversified as possible, or are all those tiny small cap companies actually just dragging down your portfolio?
And to settle this, we are pulling from a really massive stack of data today.
Oh, yeah. We've got Kiplinger Financial Research. We've got prospectuses directly from Schwab and Vanguard, ETF comparison data from Dividend Vision and Medzi, plus a handful of expert market analysis transcripts.
So our mission today is really to figure out what you are actually buying when when you hit that buy button on your brokerage app for funds like VOO, VTI, or SCHK.
Okay, let's unpack this. Because on the surface, a term like market cap weighting, I mean, it just sounds like textbook jargon that makes people's eyes glaze over.
It really does. But to even begin comparing these funds, we have to look under the hood at that specific engine driving all of them. Everything in this debate hinges on that one core mechanical concept.
Because that's the invisible hand, right? Determining where every single cent of your investment actually goes.
Exactly. So think of a market cap weighted index fund, like a massive industrial-sized bowl of soup. The allocation of the ingredients in that bowl isn't equal at all.
Right. It's not just an even mix.
Not even close. The large cap companies, so your trillion-dollar giants like Apple, Microsoft, NVIDIA, they are the rich broth and the heavy chunks of meat. They make up the vast, overwhelming majority of the substance in the bowl.
Oh, I see. So what are the mid caps then?
The mid caps might be, a handful of noodles.
Yeah.
And the small cap companies, despite there being literally thousands of them, are just a tiny pinch of salt sprinkled on top.
Just a pinch of salt.
Yeah, they're in the bowl technically, but they aren't providing the calories.
I really love that visual. But let's put some hard numbers to that recipe. Because when you buy a total market fund like VTI, the Vanguard Total Stock Market ETF, you are technically buying a piece of over 3,500 publicly traded U.S. companies.
Which sounds incredibly robust. You feel like you own this huge slice of American capitalism itself.
Yeah, but the feeling of diversification is powerful, whereas the math tells kind of a different story.
Right.
Because VTI allocates your money based on the sheer size or the market capitalization of the companies.
Right, and because of that, the large caps make up roughly 72 to 82% of the entire fund. The mid caps take up about 17%.
Wow, so the small caps, those thousands of smaller companies that actually make up the bulk of that 3,500 number, they only account for about 5 to 8% of your actual investment.
Exactly, just 5 to 8%.
Wait, really? So buying a total market fund is essentially like going to a massive music festival with 3,500 bands on the lineup, but like 82% of the speakers in the venue are exclusively broadcasting the 500 main stage headliners.
That is a perfect way to put it. You might be standing at the tiny indie stage in the back, but the sound of the stadium rock band is just drowning out almost everything else.
That's wild.
Yeah, if you put $1 into VTI, roughly 72 to 82 cents is immediately diverted into the exact same large cap companies that make up the S&P 500.
Which brings us to VO, Vanguard's S&P 500 ETF. This is the main stage. But this is where I actually want to push back on the common narrative a bit.
How so?
Well, the S&P 500 isn't just an automated list of the 500 biggest companies sorted by a computer, right? There is an actual human element, like a filter, that makes it fundamentally different from a total market fund.
A very strict filter, yeah. The total market fund, VTI, is basically a purely passive net. If a company is based in the U.S. and meets basic liquidity requirements to be traded, it just gets scooped up in the net.
But VOO is different.
Right. The S&P 500 is actively curated by a committee at Standard & Poor's. To get into that club, a company needs to meet strict criteria.
And the most vital one being 4 consecutive quarters of positive GAAP earnings, right?
Yes, generally accepted accounting principles.
Meaning you can't just show up with a bunch of projected growth and, adjusted revenue figures that look great in a pitch deck. You literally have to prove cold, hard, audited profitability for a full year before they even look at you.
Which creates this massive profitability moat around the S&P 500. There's a really fascinating example from our sources about this involving SpaceX.
Oh, right. SpaceX is huge.
It is a behemoth. It has an estimated private valuation of around $1.75 trillion. But even if its operating company were to go public tomorrow, it could be entirely excluded from the S&P 500 if it didn't meet those exact standardized earnings principles.
That is crazy to think about.
So VOO gives you the 500 most established, vetted, profitable giants. VTI gives you those exact same giants, plus 3,000 smaller companies, completely regardless of whether they are making a dime.
And this is where I get really tripped up, because looking at the recent economic data in our sources, it shows a shocking 30 to 40% of companies in broader small cap indices, like the Russell 2000, are currently unprofitable.
Yeah, that is a huge chunk of the sector.
Plus, high interest rates are just choking it right now.
Yeah.
If 40% of that sector is unprofitable, owning the total market kind of feels like buying a basket of rotting fruit just because a few of the apples on top are pristine.
That's a fair point.
So why not just abandon VTI altogether and stick to the guaranteed profits of the S&P 500? Why does anyone bother holding them?
Well, to understand why people still flock to total market funds, we really have to look at the mechanics of debt and growth. You mentioned interest rates. So let's look at why small caps are struggling so much right now compared to the giants.
Okay, lay it out for us.
Mega cap tech companies are essentially operating like banks right now. They are sitting on literal mountains of cash.
Wow.
When interest rates go up to 5%, those massive companies are actually earning billions in yield on their cash reserves.
Oh, so it actually benefits them.
Exactly. Small companies, conversely, rarely have huge cash reserves. They rely heavily on floating rate debt just to fund their daily operations and expansion.
So when their loans come due, they are forced to refinance at those higher 5 or 7% rates,
Right.
which instantly vaporizes whatever profit margins they had.
It acts as a massive anchor on their balance sheets.
Right.
But the reason investors tolerate this, the reason they are willing to hold that basket of potentially rotting fruit, goes back to the foundational philosophy of Jack Bogle, the creator of the index fund.
Right, Bogle's classic thesis.
Yeah, his thesis was that markets are highly efficient and human committees are prone to error. By owning the entire market, you capture the growth wherever it happens without ever trying to predict it.
So you're basically trying to catch the next Amazon or Netflix while it's still, trading out of a garage way before the S&P committee ever notices it.
Precisely. The total market gives you exposure to cyclical market rebounds. Small caps are notoriously volatile, but they are capable of sudden, really explosive growth spurts.
So total market investors get to capture those early-stage multi-bagger winners stocks that double, triple, or quadruple in value.
Right, and they get them before they get big enough to be admitted into the S&P 500. By the time a company is vetted, profitable, and joins VOO, a massive portion of its most aggressive exponential growth phase is already in the rearview mirror.
Okay, the Bogle philosophy of owning absolutely everything sounds super romantic, capturing the scrappy garage startup before it goes mainstream. But does the math actually support that romance?
Let's look at the numbers.
Yeah, let's move away from the philosophy and look at the head-to-head breakdown. We have VOO representing the S&P 500, VTI representing the total market, and we're also introducing SCHK into the mix, which is the Schwab 1000.
SCHK is actually the perfect control group for this experiment. It tracks the 1,000 largest U.S. companies.
So it gives you the top 500 giants plus the next 500 mid-caps.
Exactly, which captures about 90% of the investable U.S. market. But crucially, it completely cuts off the bottom 2,500 smallest, most unprofitable companies that VTI holds. It essentially strips out the bottom of the barrel.
And before we hit the returns, the one massive advantage for you, the listener, is that all three of these heavyweight ETFs share a rock-bottom expense ratio of just 0.03%.
It's incredibly cheap.
You're paying literally $3 a year for every $10,000 you invest. It is practically free. But I was looking at the 10-year annualized returns in the data, and my jaw dropped.
Oh, yeah.
Between the curated S&P 500 and the sprawling total market, the difference is almost non-existent.
The numbers are incredibly tight. If we look at the annualized returns over a 10-year period, VOO, so the top 500 stocks, delivered roughly 14.9%.
Okay, 14.9.
SCHK, the top 1,000 stocks, delivered roughly 14.5%. And VTI, the total market with over 3,600 stocks, delivered 14.4%.
14.9, 14.5, 14.4. There's a 3,100 stock difference between VOO and VTI. You are carrying the weight of over 3,000 additional companies on your back, and your reward, or your penalty really, is a 0.5% difference in your annualized return over an entire decade.
It perfectly illustrates the sheer, inescapable gravity of market cap weighting. The small caps are just statistical noise at the portfolio level.
Because the top is just so heavy.
Right. Because Apple, Microsoft, and NVIDIA make up such a colossal percentage of the total market's wealth, when they move up 5%, they just drag both VOO and VTI up in almost perfect lockstep.
We really shouldn't dismiss 0.5% as total pocket change, though. I mean, if you take a $10,000 investment and compound it over 20 years, a 0.5% gap translates to a difference of about $12,000 in your final balance.
That's true.
12 grand is real money. You could buy a decent used car with that.
If we connect this to the bigger picture, it is absolutely real money. But in the context of decades of investing, the primary takeaway is that the inclusion or exclusion of small caps does not fundamentally alter the trajectory of your wealth.
The large caps are steering the ship.
Exactly. The large caps are steering the ship, and the small caps are just passengers down in the cargo hold.
Which naturally pivots everyone straight to the issue of risk. Because if the large caps are steering the ship and the returns are basically the same, people get terrified that the stock market has essentially morphed into a giant, top-heavy tech fund.
Oh, absolutely. The prevailing anxiety right now is concentration risk. It's the single most common fear among modern index investors.
And it makes intuitive sense, right? We were talking about the Magnificent Seven: Apple, NVIDIA, Microsoft, Alphabet, Amazon, Meta, Tesla.
The heavy hitters.
Yeah, and in VOO, those top tech giants make up roughly 35% of the entire fund. More than a third of the S&P 500 is dictated by just 7 companies.
It's staggering when you frame it like that.
So, as an everyday investor looking at that, my instinct is to want to dilute that risk. If I buy SCHK with 1,000 stocks or VTI with 3,600 stocks instead of VOO's 500, doesn't that mathematically spread out my risk?
That's what most people think.
Right. Doesn't adding thousands of companies protect me if big tech suddenly takes a massive hit?
It is a completely logical assumption, but we need to debunk this myth entirely right now because the math of market cap weighting is incredibly counterintuitive. Adding thousands of stocks to a market cap weighted index barely moves the needle on your concentration risk.
How is that even mathematically possible, though? If I'm holding 1,000 stocks, my reliance on the top 7 has to go down drastically just by the sheer volume of new assets, doesn't it?
Think of it like trying to balance out a seesaw where a 5-ton elephant is sitting on one end and you decide the solution is to add 1,000 hamsters to the other end.
Okay, that's hilarious.
But it's true. The numbers sound incredibly impressive. 1,000 is a big number, but the weight doesn't shift at all. The elephant still completely controls the seesaw.
Because Apple and NVIDIA are $3 trillion behemoths.
Right. When you move from VOO to SCHK, you are basically adding stocks number 501 through 1,000. Their individual market caps are tiny compared to the giants.
So the top-heavy nature stays completely intact regardless.
Exactly. Look at the actual weightings from the prospectuses. The top 10 stocks make up about 35% of VOO. In SCHK, even with double the total companies, those exact same top 10 still make up roughly 32% of the fund.
And what about VTI?
In VTI, with over 3,600 companies, the top 10 still command about 31% of your money.
Wow. By adding 3,100 companies, I am only reducing my exposure to the top 10 by about 4 percentage points. That is wild. The hamsters are doing absolutely nothing to the elephant.
Nothing at all. And this brings up a critical lesson for anyone trying to manage risk in their portfolio. The overlap between VOO and VTI by weight is roughly 82 to 88%.
That's a huge overlap.
It is. If you actually want to dilute concentration risk, if you are truly terrified of big tech crashing and want a genuinely balanced portfolio, buying a broader market cap weighted index won't save you. You are just buying the exact same risk profile with a microscopic variation at the tail end.
So what actually fixes the seesaw then?
You would need to buy a completely different structural product, like, say, an equal-weight S&P 500 fund. In an equal-weight fund, the mechanics change entirely.
Well, so?
The 500th smallest company gets the exact same dollar allocation as Apple. If you invest $500, $1 goes to Microsoft and $1 goes to Macy's. That actually shifts the risk away from big tech.
But the massive trade-off there is that you miss out on the incredible momentum of those giants when they go on a historic run, right?
Exactly.
Because if NVIDIA triples in an equal weight fund, it doesn't pull your whole portfolio up the way it does in a market cap weighted fund. You cap your upside to protect your downside.
Investing is always an exchange of risks. But for our listeners debating between VOO, SCHK, and VTI, the realization is actually quite liberating. You aren't really choosing between different risk profiles at all.
Which brings us to the ultimate synthesis of all this data. If you are listening to this right now, staring at your brokerage app, trying to decide where to automate your next paycheck contribution, the absolute most important lesson here is do not suffer from analysis paralysis.
Please don't. Sitting in cash for 6 months trying to optimize a 0.5% historical difference between these funds is the most expensive mistake you can possibly make.
Right, you will lose far more in miscompounding than you could ever gain by picking the quote-unquote perfect index.
And there's one massive structural advantage we haven't even touched on yet that makes all three of these funds brilliant choices, and that's taxes.
Oh yeah. Our sources from Medzi and Kiplinger highlight that VOO, SCHK, and VTI are incredibly tax efficient. In fact, neither VOO nor VTI has ever made a capital gains distribution.
Which is a huge aha moment for many investors. People always wonder how these funds can constantly buy and sell stocks to rebalance the index without triggering massive tax bills for the people holding the ETF.
Right, because normally if a mutual fund manager sells a stock that has gone up, it triggers a capital gains tax event for everyone holding the fund.
Yeah.
So how do ETFs avoid that?
It comes down to a really brilliant mechanism called in-kind redemptions.
Okay, how does that work?
Well, when an ETF needs to rebalance or when investors want to cash out, the fund managers don't actually go to the open market and sell the shares for cash.
They don't.
No. Instead, they do a direct swap with large institutional market makers. They trade baskets of the underlying stocks directly for ETF shares. Because there is no actual cash transaction involved in that exchange, the IRS doesn't recognize it as a taxable sale.
Oh, wow. So no internal cash sale means no internal capital gains taxes are passed on to you.
Exactly. You get all the growth, all the rebalancing, and none of the surprise tax bills at the end of the year just for holding the fund.
They are cheap, they are tax efficient, and they perform almost identically.
Yeah.
So here is the punchy advice to take away from this deep dive. Just pick the fund that aligns with how you view the world.
Keep it simple.
Exactly. If you trust a committee to filter out the unprofitable junk, and you just want the 500 biggest, most vetted winners, buy VOO.
Right.
If you want a clean list of the top 1,000 companies that captures 90% of the market but snips off the tiniest microcaps, SCHK is a fantastic middle ground.
And if you believe in Jack Bogle's pure thesis of total market efficiency, that capturing the next garage startup is absolutely worth the volatility, go with VTI.
Pick one, set up your automatic investments, and just go live your life.
Automating the behavior is far more important than optimizing the fund. But I do want to leave you with one final, slightly provocative thought to mull over, especially for the VTI purists out there who insist on owning every single stock.
Oh, here we go.
We just established that 82% of VTI behaves exactly like VOO. The remaining 18% is heavily dragged down by a small cap sector where 30 to 40% of the companies are losing money and getting choked by interest rates.
The rotting fruit in the basket, basically.
So, are total market investors accidentally buying the market's worst junk, dragging down their own returns by 0.5% just to buy themselves the feeling of diversification?
That is a harsh way to look at it, but yeah.
Are you ruining a perfectly good nutrient-dense broth by dumping in a handful of cheap salt just because you want to say you own the whole pantry?
Oh man, that is a sharp question to end on. Does the psychological comfort of owning absolutely everything actually justify holding the bottom of the barrel? Definitely something to think about the next time you open your portfolio.
Absolutely.
Well, thank you for joining us on this deep dive. Keep asking the sharp questions, and we'll see you next time.